right. Well, thanks, everyone. We're going to turn the conversation to financing now. You know, with any good idea, it's always important to think about the financing strategy early on in the process. You know, the best laid technical plans and ideas might not get anywhere unless there's a robust financing strategy behind it. And we have a real all-star panel here today to discuss these issues with you. My name's Tyson Dyck. I'm a partner at the law firm Torys. I lead our climate and emissions trading practice. And I'm going to turn it over to my colleagues here to quickly introduce themselves, starting with Andrew Hall, who's with TD Securities.
Yeah, good morning, everyone. Andrew Hall with TD Securities. I'm a managing director and head of carbon advisory, which is our environmental commodities business.
Good morning, Jeff Pearson. I run the carbon solutions business within Wolf Midstream. Ian talked about it a little bit yesterday, but we built the CTL and a bunch of carbon infrastructure. And I come from a background, private equity, and then have the last two iterations of companies I've worked for have both been funded by institutional investment capital, private equity mostly.
Sitting next to a former investor. One of my business, John. My name is Jonathan Rhone. I'm a serial entrepreneur, and originally oil and gas background, but have spent the last 25 years building industrial OEM service project businesses in Canada and the U.S. I'm a CEO and founder of CO280. We're a project developer of carbon removal projects, and I'll talk a little bit more about what that means. But we're exclusively focused on partnering with pulp and paper companies. We have partnerships with just about every major pulp and paper company in North America. So we're implementing what Amazon's vision is today, and we've got about 15 projects in active development in the Gulf Coast and in Canada. Each one of them is about 800 to 1 million tons a year, will generate 1.5 to 2 billion in CDR revenue offtake. First project is fully sold and will be at FID in 2026. So pretty exciting time. Really pleased to be here. Thank you.
Yeah, thanks, guys. Really great, diverse perspectives on stage here. So, John, I'd like to start with you with my first question. And I was wondering if you could describe the steps a company or project should be taking to prepare for a first-of-a-kind BECCS financing.
Yeah, I think just a couple of observations. This is kind of how we think about it as we approach what we're doing. We didn't actually start, Tyson, to become a carbon capture and sequestration developer in pulp and paper. We started out to solve a business problem, which is our belief was that if we could find the right pathway that provided permanent, affordable carbon removal that's verifiable at the lowest price that could scale before 2030, that type of pathway was going to command a disproportionate share of the emerging CDR market. And so we looked at all sorts of different pathways, and we settled on using conventional amines technology to start with in pulp and paper, because that pathway is the most competitive CDR today, and I think it bears out because we have over $5 billion of commitments from some of the largest buyers to place in the next group of projects. So that's kind of a little bit of background. How do we go about it? You know, it starts with us. It starts with business model alignment. So we spend a lot of time with our pulp and paper partners trying to understand their objectives. And carbon removal is completely new to them. We're not building a new paper mill. We're not building a new biomass CHP system. We're creating a new industry, and it's leveraged off of the infrastructure of the existing pulp and paper plants. And the size of these assets are equivalent to the capital required to be invested. So starts with business model alignment, then it goes into a full business case development of how do you pull together the right technology to selection, what's the right, how does it integrate into mill operations without disrupting the mill, offtake agreements with transport and storage companies, offtake agreements for revenue, tax credits, economic model, contracting package, all that has to be wrapped up. And Tyson, this will be, not news to you, but it has to be a bankable, financeable package that gets project finance, because none of these projects are going to be on balance sheet. They're all going to be off balance sheet. So our model is a 50-50 joint venture with our pulp and paper partners that returns an extraordinary amount of new EBITDA back to the mill that can propel a third quartile mill to first quartile. So it starts with alignment on business model and kind of cascades from there.
And Jeff, maybe over to you. Does that ring true to you? I mean, I know you have a private equity background. Wolf has been a leader in investing in transportation and now sequestration infrastructure. How do you guys evaluate investment opportunities?
Yeah, it's along a very similar vein. I'd say, so we got into building the Alberta Carbon Trunk Line project, started looking at that in 2016. And I would assume many of us in the room that are now in the carbon space probably weren't in the carbon space in 2016. There wasn't much of a carbon space in 2016. And really, we got into that project with a view around developing energy infrastructure. We're energy infrastructure developers. We got into that and set it up so that, again, that was an early stage investment, but we had the revenue metrics there. We had the cash flows. We had protection around those cash flows. And then we spent a bunch of time around that, and then we spent a bunch of time on the execution side. Because I think one of the things you move from the contracting and commercial side, especially in this day and age, very quickly into the execution side. And the execution side is it's a pretty challenging environment today from a construction perspective. But my partners had all had come off another private equity startup, sold that where they had built pipelines. So we had a number of the people I work with good at building pipelines. So when we were setting up the Alberta Carbon Trunk Line project, we had the revenue side working with Ian and his team and the Enhanced team. And then we had the ability and confidence, the ability to go out and build that pipeline and build it for good value and good cost, knowing that then the economics of the whole project worked. We actually did project finance that one, even though we're funded, our capital providers, the Canada Pension Plan, but we actually put a project finance structure in place that required us to go to we had an independent engineer. We went to that independent engineer with milestone-based payments for cash draws and everything else. And so we had that structure sort of wrapped around, again, I think just to hold us really accountable. And so we start with that in all cases, though. Look at the revenue model. I'd say the other thing we look at, we look at sort of does it meet our capabilities? Does it leverage our existing assets, or does it leverage existing relationships? And ideally, it's a combination of all three.
Andrew, maybe over to you now. I know TD Securities has done a number of very innovative offtakes. What do you look at when you're evaluating investment opportunities?
So in terms of investment opportunities, I mean, to date we've invested in an MBS project in Northern Ontario, and then we've also done an offtake with a company called 1.5. It's backed by Oxy. They're building the first commercial scale CDR facility. It's DAC technology, not BECCS, that should COD next year. In terms of what we look for investments, we ourselves wouldn't necessarily be directly investing. We'd be working with a lot of our sponsor clients, our institutional investor clients who are looking to invest in this space, recognizing the growth opportunity that we've heard about over the last couple of days. And there are a fair number that are, either have invested or are circling. The types of investors that you get right now are those that are willing to take technology risk, development risk, operational risk. So it's not necessarily the, traditional capital markets, debt financing or project financing that are available right now. That will come as these projects are de-risked, as these first few projects across the different CDR technology spectrum get built, start to operate, develop a track record. That's when I think you start to see, more traditional financial mechanisms become available to the sector, including bank debt. And that's really, at the point where TD itself would probably step in to lend to some of these companies. In addition to the investors that are out there right now, strategics are really important, right? When you look at 1.5 and why that's moving forward with a $1.3 billion US facility is because it is backed by Oxy and they have the balance sheet to do that. So I think strategics play a really important role at this stage in terms of financing some of these early projects that do carry a fair bit of development, construction, technology risk with them.
Let's just pick up on that question to the whole panel. If you're rolling up your sleeves and thinking about some of those risks and some of the investment barriers that might be in front of you, we've heard over the past day and a half, discussions around the sustainability of feedstock, technology risk, political risk, carbon pricing risk. What are some of the key investment barriers that you see in this space and for BECCS projects in particular? I'll just open it up to the panel if someone wants to jump in.
I think the biggest thing right now that would help facilitate investment and de-risking of a project is the offtakes. Is somebody that's willing to take, not 10,000 tons, 20,000 tons, but 200,000 tons a year for 10 years. That's going to be really, really important, and I think it's going to attract a lot of interest from those investors that I just mentioned who are willing to take some of these other types of risks. So I know CO280's had great success in terms of getting these offtakes in place, and that's, as we talk to different developers that are out there, again, across the CDR technology spectrum, the need for, let's call them bankable offtakes, so not only offtakes, but offtakes from credit-worthy counterparties are just really, really foundational and important to de-risking the projects. It doesn't obviously de-risk them completely, but it adds that layer of comfort that I think is necessary for a lot of folks to step in and place capital into a project or into a company.
John, it looks like you have some thoughts.
I try to remember. I think it was James Carville who said, "It's all about the offtake, stupid." Is that? Yeah, I mean, there's we do kind of a rolling risk assessment on. I mean, project development is all about reducing risk at different stages with increasing amounts of money. So, I kind of bucket the risks, and there's lots of them, into a number of categories. So, just talk about offtakes for a second. Offtakes are essential. What we're aiming at is somewhere between 75% and 80% of all of the net CDR from our projects to be sold under long-term fixed price contracts indexed to inflation over a minimum of 12 years. In the U.S., we typically do 12 years because 45Q is 12 years. So we just line up all the offtakes. T&S offtake 12 years plus an option, 12 years for CDR, 12 years for how we think about project finance, and it works. Canada probably be a little bit longer, 15 years. The offtake, there's no such thing as a standard CDR offtake contract. I don't know if Natalie's here. Natalie's my co-founder. Natalie's one of the world experts in her whole team does nothing but monetize CDR. Natalie comes from Climeworks and originally before that Google, and she's an amazing partner and also does a great job with our team. Works with all of our partners and our CDR partners and our pulp and paper partners as we put these JVs together. Other big risks for these projects, anytime you're putting a big piece of equipment inside an operating plant, mill integration is a big deal. The mills have to provide all of the utilities, those steam, water, power, so the mill integration piece is very important to get right. For those friends of ours, we have a strategic partnership with SLB. We also work with other amines companies. Amines are just getting commercial. There's not hundreds of plants. They've been well proven on other applications, but CO2 is relatively new. So all these applications are relatively new. So we're piloting right now with SLB. It's a significant effort at our first project in Louisiana. So we're running an amine system pulling flue gas out of recovery boiler flue gas. The other big risks are transport and storage and permitting. Alberta has a real advantage in this area in terms of the confidence to be able to get to permits within a reasonable period of time. The U.S. has been slow. Class 6 well permits in the U.S. have been delayed by EPA. Some of the states now have primacy. That's a big risk. Transport and storage, community engagement. So it goes on and on and on. There's a lot of risks. There's a lot of pieces, and that's why we take a very collaborative approach working with our partners to kind of put this whole value chain together, and it requires a lot of partnerships, which is and everybody in the partnership value chain has to win, and it's really important to focus on that. At the end of the day, we're going to take a package of contracts that all create the bankable ecosystem, and that has to be financeable. And so then you have to share the risk across that value chain equitably. So lots of complexity. It's doable, but it's complicated.
Jeff, maybe you could talk a little bit about the risks that you'd see on more the transportation side. I know you have the Alberta Carbon Trunk Line. We're talking about linear infrastructure that carries with it a whole set of unique risks, I think. What have you seen in developing some of your projects?
Yeah, and maybe I'll expand it even beyond that. So Wolf built the Alberta Carbon Trunk Line. We've got 2 compressor stations we built, which are more facility-style investments than long linear assets. And we're actually, some of my partners, one of our business lines is natural gas liquids. We're building a $1 billion natural gas liquids facility up in Fort McMurray right now, and in the Edmonton area. And one of the, I talk about it, project execution. That's being one of the big risks today. You've got Dow is a huge project up in the Edmonton area. They've got Lindy's working to provide the CO2, the hydrogen to that. So that's a large project. That's about $11 billion combined between the two of them. You've got Air Products building a $2 billion facility. So you've got this real large demand for construction services, which creates issues around access to labor, access to components. You've got a supply chain that's a bit challenged today on the back end of COVID still. So that's getting better over time. So we look at project execution. We modularize a lot of stuff on the facility side. So it gets built in Edmonton, moved up there, put together, and it reduces the risk. The pipeline side, I think, is a bit of an easier side. We've got a long history of building pipelines in Alberta. We recently, last fall, built a 38-kilometer pipeline that runs from Air Products facilities, connects to the Alberta Carbon Trunk Line. Built it over the course of 4 months. The weather worked out well. Weather's often a large cost in pipeline construction because when it rains, it's tougher to build. When it's really cold, it's tougher to build. So that worked out really well. We don't see the opposition up here that we see in the U.S. to pipeline development. And then we are developing a storage project with a partner. We brought in Whitecap Resources, who's got a significant amount of subsurface experience. And so I'd say where we're really focused today is around the risks on storage and sequestration. They put 40 megatons in the ground in the Weyburn field, enhanced oil recovery. That's working well. Shell's done it at Quest. But we don't have a lot of history of subsurface storage injection. And we're still building the knowledge around that. I think you got to start doing it to better understand it. We're working closely with Patrick and his team at Alberta Environment to set the protocols, the sequestration protocol up correctly, so that we can go get insurance. Insurance being a large component in getting project finance. So we're working as you build this industry. There's a lot of details that come up that you got to work through. I think that's one of the biggest challenges. You don't know what the next challenge is going to be until you get this one solved.
Lots of work, but glad you have you guys on it. Maybe, John, I'll go back to you. I know there's no magic bullet here. You talked about how this is a real partnership among a bunch of different stakeholders for every new project, how you got to ensure everybody comes out with a win at some point. Are there business models that you see as successful in this space to help minimize risk and to make a new investment more attractive?
Well, I'm sure there's lots of different types of business models. I can really just talk to ours. We are approaching an industry that has been in operation for decades and decades. And they're really good at making forest products and pulp and paper. And we're approaching them with a a transformative opportunity to capture and monetize the value of the biogenic CO2, and it's really a completely different it's a transformative opportunity for them, and it's a completely new market for them. So we have a primary business model, which is a joint venture, and the joint venture, we think, has stood the test of time with a number of our partners, because it's a sharing of both the risk and the value. It's very common to do that in oil and gas. Joint ventures are not, oil and gas guys get up and do 3 joint ventures before breakfast, but it's not common in pulp and paper, particularly on operating assets, and so it's kind of it's not their muscle memory, but when you look at the relative sharing of risks and rewards and how to actually get to project financing and whether the mothership has enough capital to deploy for a completely new asset class versus their existing pulp and paper operations, that's where you start getting discussions with CFOs and board capital committees around what's the right way to set this up. We've actually found that in our conversations with there's half a dozen major pulp and paper companies. As we've evolved our conversations, at least a couple of those companies are now looking at setting up a separate carbon business unit and actually looking at capitalizing it differently because of the capital required to fully exploit that carbon opportunity. And we really welcome that. We've had some influence on how they think about it. But when you're behaving as a JV, it requires a lot of transparency, and it requires a lot of collaboration that is, sometimes unfamiliar and requires new muscles to be developed. So it takes time. But we've found that in virtually every case, it's really been really effective. And we have other variations on that. We will develop projects 100%. Ourselves, and we'll finance them 100%. The problem with that is it doesn't create the same degree of incentive for the mill or the pulp and paper company. Conversely, if they want to finance it 100% themselves and we work on some other arrangement, it's less of an incentive for us. So we've explored a bunch of different business models. We keep coming back to the 50-50 JV. Does that make sense?
Yeah, absolutely. Andrew and Jeff, do you have any other suggestions for the room on how you get to FID? How do you manage some of these risks, whether it's through business models or different strategies or partnerships?
Not to belabor the point, but offtakes are just so crucial and fundamental that without those, it's hard to progress. You can get to a certain point and you can attract a certain amount and type of capital, but again, these are very capital intensive projects, which makes them attractive to a bank as and when they're ready to commercialize, and in investors broadly. But those offtakes are just can't be understated how or oversaid how important that they are to the business model and to getting a project to the point where you can start to either have sort of a test scale facility of even 10,000 tons is a reasonable size, I think, in this space. But certainly when you get into the 100,000s or 1.5 is a little bit of a different situation, because it does have a strategic back in it, and it's they're able to press on even if they're not fully contracted. Although they as well have been extremely successful in securing large offtakes from we did one. Microsoft has done one. Like a lot of the big buyers have bought from 1.5. I do think then that once that facility CODs, hopefully next year. It looks like it's on schedule, if not slightly ahead of schedule. I think it'll unlock a lot of interest in the space and capital in the space, because it's going to be a proof of concept. Does it operate anywhere near nameplate capacity? What's its energy consumption? Is the sequestration working as expected? All the different pieces of the puzzle that Jonathan's described earlier are going to be proven at scale, and so. But again, if you were to pick one thing, it's offtakes.
So speaking of offtakes, I'm wondering whether there's different types of offtakes that might help address a tension that I think is out there between, and I think, John, you raised this in some of our back and forth prior to the panel, the tension between an immediate need for funding and a longer-term plan to set up a project well for off-balance sheet project financing. Interested, John, in your thoughts on that. I know, carbon streaming is a bit of a thing. It's a bit of a small thing still, but is there a way to create offtakes where you're providing some of that capital up front to help immediate funding needs, or is that just going to play a niche role in the market and there's other strategies that are better suited for the issue?
Yeah, it's a great question. I think we've had discussions with lots of different players in the offtake market. Advance payments have their own sets of liabilities, and so we have tended to avoid those. Our strategy was really simple. If the world's largest buyers want CDR at scale, and the problem is affordability, and we have the most affordable projects that are at CDR at less than $200 a ton, and if we go to them and they're not willing to do long-term offtakes, we should go do something else. And so that was kind of test number one. And now what our company's doing, what Natalie and her team are doing, is we're now planting seeds across the rest of the industry, because I think there is a general view out there that CDR is really expensive. We're grateful to what the DAC guys have done to open up the awareness about CDR, but BECCS is going to have the early scale, and you see that in projects like the project that SLB's done with Northern Lights at Ørsted. You see that with Stockholm Exergy. Our first projects have not been announced yet, but they're all in that lower price tier that I think is going to start opening up the market. But I think the challenge for us is how do we reduce some of the variable operating costs? How do we get early projects in that are low-hanging fruit, and then drive the cost down? Less energy, less steam, less power, less water, less capex, and then working with our friends in the transport and storage side of things to build out the infrastructure, because the early infrastructure is really expensive. The biggest variable cost of our projects is the interconnection pipeline between the mill and storage. Now that'll change as the downstream assets start getting built out. But I think when it comes to offtake, at the scale that we're at, it really is fixed price, and these contracts go into the JV at FID, and they're long term. So we're trying to keep it simple, because our investment banking friends are smarter than we are, and they know how to model these things in different and wonderful ways. But we like to keep that part of it simple.
Keep it simple. I like it. Let's switch gears for a minute and talk about the public sector. I know there's been some conversation over the past day around what role governments can play in all this. We have the federal government talking again about moving forward with a sustainable finance taxonomy. Hopefully BECCS will qualify as a green investment. Maybe that'll drive some capital to the space. We have CGF looking at offtake opportunities. There's a variety of things that the government is currently doing. Is that enough? Do we need more? I know different countries are doing different things. Norway has reverse auctions for CDR opportunities. What role does government need to play in this space? Open it up to the panel.
So when we look at our projects, like the ITCs was a pretty critical component. We actually, I think, were the first applicant for ITCs under the federal program for the pipeline we constructed last year. So we're working through that process. That again is just another example of great program, teams learning how to analyze and work through those because they haven't done it before. On the NRCan side, great to work with. It's just it takes time. That's been phenomenal. I think the CGF guys. I'll leave it to Jonathan to talk about credit pricing or I know Sean at Varme has also done a deal with CGF around that as well, and how that balance looks. Whether it feels like a lot of the contracts that have gone out from CGF today are at 86.50. That may not be the price that's necessary to move some of these earlier stage, possibly more expensive projects forward. Ideally down the road that gets there, but that might be a bit of an impediment today, which might lead to other markets. But we find that's great. We also, I think, are still looking at the regulatory side, and don't forget about sort of the set of rules that need to be developed, and working with government to get those set up so that this is a low risk industry. There's appropriate risk sharing between the government and private sector, and there's not these barriers to stop things from happening that seem to make sense for all of us, and we feel like they should move forward, but there's regulatory challenges in that.
You're lucky to be in Alberta. I know in Ontario we are struggling to get a regulatory regime in place for CCS, and it's moving very, very slowly. So you're light years ahead of us. With all that experience, I think you have a lot to share with the rest of the country. Anybody else with thoughts on what government should be doing here?
I have a couple thoughts. First of all, I think government has a huge role to play in helping commercialize some of the next generation of technology. I know there are several companies here, and Mantle's here, Savante's here. The industry needs the next generation of technologies that are going to drive down cost and provide more optionality to emitters, to project developers. So the cost of getting to first of a kind projects is really expensive, and there's a lot of risk, and you can't project finance that stuff. So I think large scale capital is available in the U.S. with DOE. I think we could do a better job of that large scale financing to get some of these newer technologies into the market. Number two, I'm really glad that you're working through ITC. I think ITC is a disaster. And I think it's a disaster for Canadian industry. And I'll tell you why. Because if I take the same project in Alberta and I look at the economics with an ITC, and I take that project to the U.S., no ITC, but we get the 45Q tax credits, the U.S. project's got about a 7 to 8% IRR increase. So where are you going to put your capital? And so the projects in the U.S. are more profitable. They're lower risk. The way the production tax credit is structured in the U.S., the 45Q, the first 5 years are almost like a shred payment. You make a tax filing, and you get a check. The next years 6 to 12, you have to have a tax-paying entity. And our joint venture is another advantage of having a Fortune 500 JV partner. We have a built-in tax equity partner in the project, so we can monetize the 45Q at 98 cents on the dollar. So I think that Canada trying to have its own incentive mechanism that's not competitive for private capital is a big barrier for Canadian industry. So we're going to do projects in Canada, but we're very grateful to have Canada Growth Fund here so that we can kind of ask them to help level the playing field on capital. So there you go. One was a complaint. I didn't come up here to complain, but I guess that was a complaint.
I think it's one that will resonate broadly across the room here. I think there's a delta, and that's driving capital south of the border in a lot of cases. Yeah. I have one last question for our panel, and then we can open it up to some audience questions. And I'm going to ask you all to kind of predict the future here, but where do we see financing of BECCS projects going in the future? Maybe, Andrew, I'll start with you. You had mentioned the role of strategics and how strategics can be very important in this space. Is that going to continue to be the case? Are we going to see more institutional capital, project financing going forward? How do you see that market evolving?
Yeah, I mean, I think one of the most encouraging things that you're starting to see is just the level of interest, illustrated by this conference and others like it, that, there's a lot of focus on CDR broadly and BECCS specifically, as one of these solutions that can be brought to bear to address climate change and start to, bring down parts per million in the atmosphere and so forth. And you do see sort of early stages of big institutional investment and certainly awareness. Like, we spend a lot of time talking to investors who are again, not necessarily at the point where they're ready to invest, but they're certainly circling, and that's where, again, I raise the issue of or point around 1.5 and the COD of that facility. But in that facility as well, you had BlackRock step in with $550 million investment, and so, that's the type of investment that these projects need really to get off the ground. Is they need not the $10-20 million investment, but the hundreds of millions of dollar investments. So yeah, I think that's really encouraging. I think once we get some proof of concept at scale, you'll just see a lot more capital flow into the space. There's a lot of different types of technologies. BECCS seems to be quite low cost. It's got an industry that's behind it and very supportive in the forestry sector. I think a lot of the technologies, again, are not necessarily brand new. Maybe it's a different application of the technology, so that will help. And yeah, so generally speaking, I'm positive. I think we're probably like a year or two out before we start to see maybe a transformative amount of capital flowing into the space from investors. But overall, it seems governments are stepping up to a certain extent. Just on your last question, I think the ITCs, the PTCs, concessionary capital at early stages is all going to be important to helping flesh out some of these technologies. So I think continued focus is going to be really important. More risk capital flowing into the space at this stage to allow these businesses to progress the offtakes that we've already talked about. But they all point in a positive direction.
Over to you, Jeff.
I echo what Andrew says as well. I think the strategics play a really important role when the risks are great and the capital requirements is high, because the project finance structures generally are a lower, and so is a lot of the institutional investors, the infrastructure investors are looking for a lower risk investment while providing a lower cost of capital. So driving the cost down, but not looking. It's not venture capital. It's not 30% IRRs or 30% sort of commensurate risk. It's a lower risk thing. So I think the strategics are really important in the early days of demonstrating the technology and driving the cost down. As that becomes more consistent and common, you can start to move to more project finance structures where the risk around that is reduced significantly. And I think the one thing I always think is a great thing about the CCS space and the carbon removal space, all of these technologies, like it's happening around the world. It's carbon is carbon, no matter where you're generating it. And so you've got the ability to learn off of everything that's happening in Europe, everything that's happening in the US, and we can bring all of that technology here and use it here. So it's not some of the things we used to look at, oil sands and stuff like that, were just happening here. You didn't get all of this, but here you've got the ability to learn off of the U.S. government putting a bunch of money into this stuff to de-risk it, which will only help things here. So I think we're moving as it becomes more common to a lower cost capital structure.
John, you got the last word.
I'm in violent agreement. I guess the thing I would add would be that we just see an enormous amount of capital on the sidelines. It's no fun to be a project investor in renewables right now. Nobody's making money. So as a consequence, there's just a massive pent-up amount of capital, project equity, on the sidelines, waiting for well-designed projects that have attractive returns. And I think BECCS projects can be one of the first kind of energy transition categories of new energy transition assets that can attract a disproportionate amount of capital. I do agree. So we've got pretty deep pockets within our syndicate. We're seeing some very, very active private equity, particularly out of Houston. Private equity in the U.S. is actually putting significant amount of capital to work today. Also, the strategics, I agree with you, and the strategics play a really crucial role, I think, in the next sort of 2 to 5 years. And then you kind of get into the lower risk institutions are going to sit in the sidelines and watch as projects get track record and they actually prove out their economics, they prove out their operating costs, and then you'll see a lot of assets starting to change hands. I'm bullish about this, but picking the right project equity partners at the right time in the right cycle of commercializing these new assets will be a trick shot. So.
Great reasons to be optimistic. Why don't we open it up to the audience for questions? I see one in the far back there.
Good morning. My name is Perry. I'm with West Fraser. Thank you for that excellent discussion, folks. I've got a quick question. So you said it's off balance sheet, it's a JV, but is there any performance penalties on the emitter in case there's incidents where they can't perform or give the biogenic emissions? Like, is there still an impact on the site? Because for a very risk-averse industry, when you add on a new element that their process is dependent on, there's usually some inhibitions to get into that. So, thank you.
Is that a question for me? Is that for me?
Yes, sir.
Yeah. Great question. So longer conversation, but the short answer is yes. So if you've got a new asset that's capturing CO2, you've got two fundamental risks that to think about. Somebody else has built a pipeline and a storage site, and so there's going to be a long-term offtake contract. That's going to be a take-or-pay contract. So whether the capture plant's operating or not, those guys have to get paid. Now, if they don't perform, there's a backstop the other way to backstop the capital invested in the capture plant. The other offtake is the CDR offtake. Now, at this early stage in the CDR market, without revealing anything, I'm looking at Natalie's going to throw something at me in a minute. CDR contracts today are not charity, but they're not full. They're not full like a energy performance contract. Okay, so there's a fair amount of flexibility, recognizing the stage of where we are today. So what we do is we spend a lot of time looking at the boiler performance, the track record of the mill over the last 10 years, what's the uptime and availability of the mill, and then we build flexibility into the offtake contracts to be able to accommodate the black swan events. So can you switch CDR delivery from one quarter to the next if you have an outage, right? For example, it's unplanned. So there are ways to deal with it, but it's just sort of one of the complexities of kind of putting together and distributing the liability across the different partners. But we're doing it and have done it, and it's doable. It just takes a lot of work.
I think we have time for at least one more question. Yep.
Thanks. Great panel. Thank you very much. Chris Dambrowitz with the Canada West Foundation. You've each spoken a lot about risk and risk sharing over the long term of the project, black swan events. In the context of financing as part of the play, are there innovative ways of bringing the insurance and the global groups into this conversation to provide partial floor on financing projects?
Yes. The insurance industry is figuring out how to help insure this new category of risks, kind of across the board. Transport and storage of CO2, CDR contracts, insurance against some of the things that could go wrong with a 45Q production tax credit. So there's a new category of risks that's of insurance that's evolving around this asset class. Yeah, and some really interesting things happening. I don't know if you're seeing this.
Yeah, and I'd say the same thing, especially when we look at storage again, which is newer. We're looking at insurance around, say, what happens if that CO2 comes back up? That's called a reversal. There's a large policy that's been underwritten in the U.S. And so we're working actually quite closely with the insurers around. One of the nice things is we're trying to align a lot of the stuff we're doing here with the U.S. because the U.S. is going to be such a larger market. If we can align ourselves around that, our regulations around that, we can access those suites of insurance projects or products without needing to educate them on what's different up here. And so I'd say we're working towards that. Again, the challenge with many of the insurers as well is it's nascent. They're often actuarial from the way that they price policies. When you've got a data set of one or two, it's hard to get sort of statistical around what price. And so I think pricing will come down over time, assuming we behave as an industry and it is done in a low risk basis. It's harder to access some of those today, and there's a lot more sort of one-on-one conversation going on.
And I'm aware of at least 3 different companies that are offering insurance products around carbon offset projects to cover things like regulatory risk, volumetric risk, reversals, revocations, and the like. So it's not hard to see that could extend to the specific risks that are unique to CDR technologies and BECCS specifically.
So I maybe just want to follow up on something Jeff mentioned, reversals. So reversals will end up in the CDR contract because buyers are very sensitive around reversals. So the insurance integration with if we did a deal with Wolf would have to align with the insurance requirements on reversals in the CDR contract. So there's a lot of cross fertilization, cross integration of the transactions that have to be put in place, and that's now happening. And Jeff also mentioned there's a lot we can learn from Europe. Europe's doing some really interesting work. Swiss Re is a leader in this, and there's another one. Andrew, maybe you can think of who the European insurance that you.
The ones I'm aware of, it's like Oka, Carbon Pool.
Okay, yep.
Swiss Re.
Yep. There's happy to share contacts or ideas around that.
Terrific, thank you.
Just say as a lawyer, if you can find ways to commercially insure some of those risks around invalidation and reversal, it really resolves some of the big negotiation points in some of these agreements. So I think there'll be a real market for it. Yeah. Well, big thank you to our panel. It was terrific discussion. Thanks to everyone in the audience.